Saurabh Mukherjea is with us, founder of Marcellus Investment Managers. Saurabh, great to have you with us here on the program as always. Thanks very much for your time. So just a quick snapshot view of earnings so far, the earnings season. Cursory, top-down kind of look makes one feel there are more misses than hits. Is it just the base effect at play? What's going on, in your opinion? I mean, if you agree with it.
I mean, look at the top of the rate cycle. This is broadly what you'd expect. You'd expect to see the lenders slow down their earnings growth. You'd expect to see a degree of NIM pressure at the top of the rate cycle. And similarly, if you put it in the global context, given that the global economy has slowed down over the last couple of years, and the global economy too is at the top of the rate cycle, you'd expect to see the Indian IT services companies slow down. So not surprised that you're seeing a degree of earnings slowdown. That being said, I have never seen an interest rate cycle where at the top of the interest rate cycle, you're still seeing large companies grind out 15-20% earnings growth, and you're seeing the economy grow at around 7%. So yes, it's a slowdown compared to where we were, say, 6 quarters ago. But in the context of general economic cycles, this is one of the most robust economic cycles I've seen, where even after the Western world has hike rates by 5%, you have the US stock market peaking and you have the Indian stock market rocking.
Okay, well, the Indian stock market is rocking. I don't know about that because the last couple of weeks have been rocky, not rocking really. So one just has this question on one's mind that do you see the gains of 2023 being replicated in 2024, or is it going to be a very choppy year for the market? What's your take?
I think we're in good shape, right? I mean, if you look at, let's break it into two parts. I think the small cap piece, everybody watching knows that small caps are up 150% over the last 3 years or so. I think up 45 or 50% in the last 12 months. But let's focus on the broader benchmark, the large cap benchmark. Even there, we are up in high teens. The Nifty is up high teens. Earnings compounding for larger companies are anywhere between 15 to 20%. So we're in good shape, whether we look at the market as a whole or at small caps. In small caps, I would dare say there's a degree of irrational exuberance, but that can be discussed later. For the market as a whole, we're in good shape. The US stock market is also at all-time highs. But coming back to the year ahead, if you have political clarity, which I think we have on the situation now, you have government capex moving along, and I think the union budget, the interim budget will further underscore that government capex will grow at a reasonably solid pace. And if you have the early signs of a private sector capex upturn, which I think again we have, the early signs of a private sector capex upturn, I don't see any reason why 2024 shouldn't also be a good year for a well-run large cap companies.
All right. Hi, Saurabh. Good morning. Good to see you. Saurabh, Street has been a buzz with regard to your entry and exit of various stocks. But there's a couple of stocks that I think that you have made an entry into. Amy Organics, I think that's one of them. Control Print, I think, is another one of them as well. And we have some news flow this morning on AB Organics with regard to the lithium-ion battery, that what they've been talking about for a while. Tell us more about these two recent entries that you've made.
So look, we've been researching Amy for 6 months or so. We held off buying because, given that we buy a reasonably large chunks, we were finding it difficult to get a block. Thankfully, and this is entirely fortuitous, there was a block available around a month or so ago, and it was available at a very attractive price. So we got in, I think, around the 1050 odd level, or perhaps a little lower than that. We got in at an attractive price. Why did we get in? Amy Organics supplies intermediates to some of our larger pharma holdings. So, for example, Amy Organics supplies intermediates to Divi's Lab. Divi's Lab is the 5th largest maker of APIs in the world. As I've said several times on your channel, we think there's a big story playing out in India on APIs. I think we'll pull market share from China as a country. We will pull market share from China. So Divi's Lab does well. A supplier to Divi's like Amy should do well. A different part of Amy, the lithium-ion piece, that's a business based out of Noida. That's a business they acquired a couple of years ago. And looking at India's import-export data, we figured out that this is a very high margin that Amy is involved in. Basically, they're supplying stuff into the ecosystem, going not just into EVs, but also into the semiconductor ecosystem. So we felt that for the price that we were paying for that block deal that took place a month ago, we were getting a credible supplier to Divi's Lab and to some of the largest European pharma manufacturers, and a company which could play the semiconductor cycle and the EV cycle. So you're getting two for the price of one, and thus the entry into Amy Organics in our Little Champs portfolio.
Saurabh, the other one I think we should talk about is, of course, HDFC Bank and what your thoughts are there. I did read your note I think, which you wrote on HDFC Bank assessing, where it stands on various parameters. But just talk to us about what do you think is going on there, and what's your own sort of sense? Will one make money in HDFC Bank from here?
Look, I think from our perspective, we certainly hope to make money. It's one of our largest positions. In fact, I think it's probably 10% of some of our portfolios. Why do we hope to make money here? Let's break it into two parts. The fundamentals piece has been good for 25 years. I don't think anybody watching this show needs to be reassured on HDFC Bank's fundamentals. It's been 20% loan book growth for many, many years. Over the last 6 months, over the last 6 years, take any horizon, this bank has pulled market share at a rate not seen in Indian banking. No other private sector bank, even in the current fiscal, no other private sector or public sector bank has come close to matching the rate at which HDFC Bank has pulled market share. Now, the concern that's historically existed is it's an expensive bank. That's been the point of view historically. Over the last 5 years, the price to book has come off from, I think, 4.5 down to now 2 almost. This is trading at the lowest price to book it's ever traded at. And therefore, that's why in the last 6 months, we increased the position size quite sharply in HDFC Bank. Obviously, the events of the last 2 weeks hurt us. When a bank of this size, in a position of this size, comes off, it hurts us. But our point of view is that the issues that the market is losing sleep about are transitional. All the data that we get, data coming from the RBI and from the bank itself, suggests a franchise which is steadily getting more muscular relative to even the other private sector banks, and hence the increase in position size, and hence the relative sort of sanguine point of view in Marcellus that yes, you could have perhaps another quarter of weak deposit growth. Remember, loan growth is not the challenge. The concern that people have is deposit growth. Perhaps you have another weak quarter of deposit growth, but that's a transient issue. The structural point of view here is that you've got a bank doing 1.9% ROA. If you gear that by 8, 9 times, an 18% ROE bank, trading at 2.2 times, 2.3 times, to my mind, that's a very attractive proposition. Quick disclaimer, myself through Marcellus, my parents through Marcellus, and our 9,000 clients through Marcellus have investments in all of these stocks I'm talking about.
So you're a buyer at these levels. You're continuing to remain positive for the stock, right? At these levels.
Absolutely.
Okay, all right. You briefly mentioned at the start of the interview as well about the private capex theme. And in the past, you've been quite positive about that. If there are signs that it's coming back, how do you play it? What are the themes?
So far, we bought RHI Magnesita 4 or 5 months ago. This is a company which supplies to steel plants the refractory material which goes into steel furnaces. We bought Grindwell Norton a couple of years ago. This is a company which supplies abrasives to, say, an auto manufacturer like Maruti, say. More recently, over the last 3 months, we've built positions in Shanti Gears. This is the second largest gears company. It's part of the Murugappa empire. The largest player is in Gujarat, but we think the largest player is losing market share to Shanti Gears. And we see this very much as a company that will do really, really well over the next 4 or 5 years as the Murugappa group improves the quality of Shanti Gears' business and turns it into a market leader. We've also bought SRF. SRF is a multinational. They are the largest player in industrial bearings. So broadly speaking, the bearings market is 2 parts, one which supplies the auto community, the other which supplies the industrial community. SRF is the largest player in industrial bearings. The stock hasn't done much over the last 12 months, largely because
SKF, right?
Demand hadn't taken off. We reckon as we go forward, the industrial capex cycle picks up, demand for industrial bearings picks up, and SRF should be a beneficiary of that.
SKF, I think, right? SKF.
Sorry, yeah, SKF. You're right. Sorry,
SKF.
SRF is the chemical company. SKF is the ball bearings company. Thanks for clarifying that. Thank you so much. Yeah.
Okay. What about some of these spaces like IT, for example? How are you feeling about them, and any of the stocks that you like over there that could do well in the near term? Because there the street is a bit divided on which way things are headed.
So IT maintained the point of view over the last couple of years as the Western economies have slowed down and the Fortune 500 companies' desire to give work to Indian companies has diminished. Our point of view has been that look, AI is upon us. The move to cloud is upon us. The bulk of the Fortune 500 companies haven't yet moved to cloud or AI, and the two are linked. It's very difficult to move to AI if you don't move to the cloud. So the bulk of the Fortune 500 haven't done that. And therefore, there is plenty of work to be done for the big Indian IT companies. It's not just a theoretical thing. We can see quarter upon quarter the order books of the Indian IT companies bulging up, right? So TCS reports anywhere between $8 to $10 billion of business. And if you can see the order books going up, it's just a question of being patient and saying, at some stage, the Western CEOs will give the green light to a TCS saying, go ahead, get the work done. We need to move to cloud and AI ASAP. Now, when that green light will come, I can't second guess that, Sonia. We try our best to be reasonably sensible about these things. And our view is that we keep the position, stay invested in a large way in TCS. In the engineering R&D space, we invested in LTTS and Tata Elxsi, stay invested there. And just wait for the Western economic cycle to turn. Now, if the Western economic cycle turns in the next 6 months, brilliant for our positions for our position in TCS. But if it turns next year, so be it. We'll have to stay patient and wait for the IT services cycle to turn. We think it'll turn. It's a question of when, not if.
Yeah. Okay, all right, Saurabh. Thanks a lot for joining in, giving us a view on various sectors as well as stocks. Look forward to having a chat with you and wishing you all the best. Sometimes, timing of these stocks a little bit difficult, but hopefully things, work in favor of all the money you're managing as well, Saurabh.